Hello and welcome to our web chat on understanding and exploiting your corporate treasury data. This is a critical area of treasury technology, and we are joined by Craig Jeffrey, Managing Partner of Strategic Treasurer, who founded the organization in 2004. We will be discussing one of the biggest problems in corporate treasury as to how to manage and exploit the different types of data available to Treasury. After examining the types of data, we'll be looking at three key aspects. So, Craig, explain how you've classified the data sources on the left here, because this is both unusual and usual at the same time.
Sure. The left-hand side where the data sources are, Treasury needs data from a number of places for forecasting, transaction management, understanding risk, and doing analysis. When you look at those, they're going to get data from internal departments, internal sources for forecasting or upcoming transactions. They need to get it from banks, and this would be, balance information, accounts, individual transactions. Maybe they're passing data back and forth for payments, and they want confirmations on those or different transactions. And then to calibrate certain elements of their system, risk, exposure, etc., they're going to get external market data. These might be a set of FX rates or other elements that they need for that. And then finally, they're going to pull in external sources of data. When you think about big data or other data sets, when you have to do analysis, these questions that come up, something's hit the market, you get asked by the board or executive leadership, what's our exposure to, Spanish banks or whatever the question is, looking at more sets of data for managing that risk or understanding how one aspect of the economy can impact the other relates to the data sources that people need.
The big data is a horrible term, and it means so many different things to different people. But there is an explosion here of what the Treasury is starting to look at. It isn't just what I would have expected 5 years ago. Now they're talking about social trends and so on. How are Treasury getting involved there?
Yeah, I agree with you. Big data is not necessarily a helpful word, but it's certainly stuck because you think of it as structured and unstructured data. Things like social trends. I think we all know, people may want to look at, forecasting changes and say, how's that going to impact our business? We sell ice cream. Well, temperature trends may change that. Kids out of school may change that. But when you start to look at what could influence an overall business or what trends could happen, looking at large sets of unstructured and structured data, not many people use that for their model, but more and more, when you're having to do analysis, you're looking and searching for other components of data.
Great. So then if we move to the right-hand side of your excellent chart, by the way, looking at the systems and the data groupings, can you explain very quickly how you've structured that?
So on the right-hand side, the bottom right-hand side is just where data that Treasury may use comes in. And so it's more of these logical groupings of there's transactional data, there's a summation of your exposures, different types of ratings or areas that you can calibrate your investments, your debt, your exposures, etc. Then there's the relationship aspect, like counterparties. Treasury thinks of counterparties as their banks primarily, but when you think about the overall organization, you have exposures to counterparties who are clients or customers, as well as vendors who are part of your supply chain. So counterparty data would include who they are, the largest vendors and clients, and certainly your banks that are in your credit or part of your operational concerns. And finally, the associations or structural data on the right-hand side allows you to bridge and build different types of connections. And that's important because data is oftentimes not normalized. We always talk about, master data records and how people fix that. And what we found is that Treasury needs to fix that outside of the underlying systems, because you're always trying to fix vendor master record information, customer master record information, all different kinds of data. Treasury experiences that too with, they're looking at their holdings, and they may have Bank of America, B of A, BAML, all as separate entities, and they're running their total aggregate exposure to an individual counterparty, and they don't see the different terms as different or as the same, and so they're not running their aggregation properly. So associations or structural data helps with that.
And then unusually you've gone beyond the Treasury systems to say that it's more than just Treasury systems you need to look at in terms of managing your data. You're talking about forecasting solutions, reconciliations, and business intelligence. My question would be, before you start to explain, is are you expecting the Treasurer to bring all this together?
Yeah, that's a good question, because the Treasurer would clearly be responsible for Treasury systems, but they are a big influence on the reconciliation platforms that a company may use, whether it's ERP or a dedicated recon system. Forecasting, there's multiple forecasting actions in a company. There's the cash forecast, the daily cash position. There's also usually the FP&A or income forecast. So they're not pulling it all together, but the top two, there's usually either direct ownership or partial ownership of those processes. Business intelligence is really part of our tech stack. When you think about the data, connectivity, systems, reporting, and analytics, if you're going to do analytics in Treasury, there's so much you can do in a Treasury system. Everything else oftentimes is done in Excel. And so business intelligence is how can I make and understand connections and self-discover. As I ask a question, a new question comes up. Treasurers need the ability to continue to ask the next question without sending someone back to gather data, build a report, come back 4 days later.
And that's essentially what you're talking about in these three aspects we're going to be looking at. The first aspect is using data in multiple ways. Now, that's obvious, but there are some subtleties around how you use data in multiple ways. Can you explain?
Sure. When we think about data in multiple ways, there's a couple of different ways we can think about that. One is you have a bunch of data on the left-hand side here where you have information from banks, let's say individual transactions coming through bank accounts. 2, 3, or 4 constituents may want that data and use it in different ways. So one is, I need that transactional data for my reconciliation platform. My bank reconciliation is matching book to bank. I need the bank information in, that needs to come in. I'm using it to match off to make sure I can detect any problems. So timing has a different purpose and matter, etc. I need those transactions, I need those balances in my treasury management system to see where my cash is what's in my account today what I expect. If it's not what I expect, is something going to happen later? So there's using that same data in 2 different ways right there.
Question that comes from that is there a particular way of organizing your data so you can use it in multiple ways?
Yeah, and that speaks to what we refer to as the conceptual treasury technology stack, which is I've got data, I've got connectivity, I've got systems. Well, I have that data, I need to move it and transport it, and I need to consume it in systems or make it available for other functions and purposes. So I won't go into the middle section, but the middle section is moving it over and making it available either directly into, for example, on the recon side, both into the reconciliation system, into the treasury system, maybe into the ERP, but there might be a transformational element as well. The data comes back, I stick it and transform it, in that bottom section on the right, where now it's available for other tools, other sources, like maybe it's embedded within a TMS into their tables, embedded into a reconciliation to their tables, but I could be sticking it in either data warehouse or a different directory that I can then access for other purposes. And that may include some of that structural data where I take it so that you can understand the connection between an entity and the entity hierarchy, the owning company and subsidiaries, for example.
And that really leads us to the next aspect that you stressed is important, is being flexible in the use of data. First, you're talking about using it in multiple ways. Now, what do you mean by being flexible in the use of data?
this is the challenge of Treasury, and the delight of Treasury is that new stuff comes up. Well, it doesn't seem like a delight all the time. When a new risk or situation comes up, Treasury is oftentimes very different than accounting, for example. So our sisters and brothers in accounting, when there's some sort of change in need for reporting, IFRS or GAAP, there's 2, 3, or 4 years, there's a comment period before they have to make the changes, which may say, oh, now I need more data, I need to report things differently. I've got this pace that would seem completely leisurely to the treasurer in terms of pulling and making a response. When we say flexibility of data, is anything that's standard. Here, what's my cash by account, currency, country, bank, whatever, is a standard reporting thing for Treasury. That's just something that comes out. But there's new questions that come up. We may say, we already understand we need to know cash flow at risk. We build a process that it reports and functions, like a machine. But other things come up. What's our exposure to, I picked on Spanish banks, but let's just say, Spanish banks or Spanish companies. Or there's some kind of event that occurs. There was an earthquake, which led to a tsunami, which impacted a nuclear reactor in the northern part of Japan not that long ago. What is our exposure to lending banks, to our supply chain, to any customers we have? So this is a question that how is that going to impact us? Everyone's scurrying. And so if you had information on the bottom, like the structural data associations, like industry or location might become very important then, just to see what the impact would be there, or the impact of something in southwestern Europe, or what's going on in the US or Mexico.
Okay, so it's both using the data in multiple ways, being flexible and making it available to other people. You've got this third aspect, which you talk about as data normalization. What do you mean here?
Yeah, so normalizing data, I think I gave a little bit of an example of it, but didn't refer to it as normalizing it. This is you have data in different tables. It's all over the place. People are used to keying that stuff and manually in their heads normalizing when they enter it into the Excel spreadsheet for their management report. Oh, Bank of America, I put that in there. B of A, okay, no, that's the same as Bank of America. BAML or Bank of America Merrill Lynch, there's a way of normalizing those so that those are all associated with your exposures to a financial counterparty. That's one aspect of it. The other part, Jack, that I would like to say is when you're pulling data in for forecasting or looking at risk, it's nice to say, hey, we identified problems with the underlying data. The normal process that people go through to fix it is they say, we'll have a master data management or master data record management. We're going to go and fix the problems we have in AR, AP. We've got this one company set up 8 different times. We're going to, put a structure over that so that those sub-entities are linked to it. Okay, we're going to wait for that. Well, that doesn't work for Treasury.
Yeah, it doesn't, but what do they do about it?
So yes, they can continue those other areas. That's a good question, because other areas can continue to fix and clean up their data, but you have to understand that the challenge is those other systems are always going to have data problems. Therefore, to fix it on a recurring basis is you can't wait for them to fix it. You want it to be fixed, so you would do things. You would normalize it and create some structural fixes. So you might put these entities, B of A, Bank of America, et cetera, or whatever the codes are, the CUSIP, the CETL, the ISINs. You link those together so they link back to a common structure, common counterparty, or a common summary data, so that you can, once you identify the problem, you can tell the other area, but you have a table-driven process to normalize those, so you make decisions based on right data.
And that, in a way, is the whole point about understanding and exploiting your corporate treasury data. You've got to understand and use the right data. Data is critical to the role of corporate treasury, but how are they going to impose their will on the rest of the corporation? Because it's critical for the effectiveness of Treasury, but also the effectiveness of the whole company.
Imposing their will on the whole organization is that might be a bit too much to do, and part of what we're saying is, I mean, there is a, on the right hand side we saw the business intelligence category as far as systems, et cetera. So whether you use a BI capability that's built within your Treasury system, whether you leverage the business intelligence tool that the company's using, like the Microsoft Stack, ClickView, Domo, whatever, you still want to leverage the technology that's there. Part of what I'm saying is you don't impose your will on the whole organization. Is you can get data from within the organization, moving it, but you usually have to do some transformation. But the data groupings, categories, and structure mean we can get what we need for Treasury to be adaptable, to be flexible, to use it in multiple ways, without being wholly dependent on someone else fixing something in their own time.
And that's essentially the essence of the corporate Treasury department. It's bringing it all together so you can see the overall picture. Would that be your assessment?
That would be part of it. And what we're seeing too is when you start to push data, I'll give an example. One company, they're trying to build their data warehouses and create consistent processes, because this macro view and the use of whether they call it big data or analysis that cuts across an individual system or some of these separate tables is a challenge and increasing demand. So when you make that data available to other areas, and IT and finance, whatever, now it can be consumed. Oh, you have all the rates. They can be used in the accounting systems too. You have this structural data. They can be looked at and used by anybody. So in a way, it helps IT, because IT is always trying to corral all these different areas who do everything on their own in a different way that's not repeatable or reusable for the rest of the organization. So this usually fits into what IT's trying to do while maintaining some of the distinctives of what Treasury needs to do in terms of fast response and analysis, as well as the regular day-to-day forecasting, positioning, liquidity management.
Thank you, Craig. Very interesting and incredibly important.